Greetings, everyone. Scott Richardson, Dan Brown from Richardson Capital Management, here to provide the 2025 second quarter economic and investment update. Needless to say, there's a lot of activity that occurred during the course of the quarter. Good news is the financial markets performed very favorably the last couple months of the quarter, and stocks broadly were up in May and June, finished the quarter positive. And fixed income also had a solid quarter as interest rates fell and corporate credit remains strong as the economy is hanging in there. So the bond market's hung in there as well. The one area that's been a little bit weak has been the energy sector, and the price of oil bounced around a bit during the course of the quarter. When the Israel-Iran conflict broke out, we had oil go from $65 a barrel roughly to $75 a barrel. But once we got the ceasefire in place, oil fell back down to about that $65 range and finished the quarter lower, which is good for inflation and expenses for us, but negatively impacted the energy sector. A little volatile, finished strong, but let me turn it over to Dan to give us a little bit more detail on exactly what all played out and contributed to the movements.
Sure, Scott. So we saw a pretty V-shaped rally so far year to date here, with the stock market going down the months February, March, and April on the tariff concern. And then we saw some clarity in May and June, which caused a fairly meaningful rally off the April lows. So from the April lows through the end of the quarter, June 30th, we saw about a 25% rally in the stock market. So again, almost a perfect V going down February, March, and April, and then bouncing meaningfully middle of April through the end of June. So what we saw in May was the fact that the U.S. and China came to an agreement on tariffs, with tariff policy for China imports going down from about 145% to 30%. So still higher than where we were to begin the year, but nonetheless, we think it's fairly manageable for most companies. And then in June, we saw hints that the administration was going to push out the 90-day pause. So if we go back to April and the lows that were put in, that's when the administration announced that there would be a 90-day pause put in place. That 90-day pause basically ends the first week of July, and the administration hinted that that could still be pushed out further into the future. So the stock market investors reacted positively. So again, finishing the month with a very strong quarter.
So Dan, let's talk a little bit about the Federal Reserve, because that's obviously a big piece of what's going on in the financial markets and everybody trying to figure out what's going on that front. We had a meeting in June where the Fed met, kept rates steady. We've got obviously a couple more meetings coming up throughout the balance of the year. We've got expectations on what's going to play out. Can you just kind of give us, what the lay of the land is at this point on where we're at on interest rates and what the expectations are?
Yeah, so the Fed's been on pause basically since December of last year. So just going back to last year to recap where we are with Fed funds interest rates, we saw the first cut occur in September. That was 0.5%. And then November and December, we saw a quarter point cut. And then the Fed started talking about the fact that they were concerned about inflation spiking with all of the tariffs introducing potentially higher prices for consumers. So the past couple of months now, the Fed has been pretty adamant, especially the Fed Chairman Jerome Powell, about taking a wait and see approach on inflation to make sure that it doesn't spike further from here. So the graph that we're showing here is the consumer price index, basically going back a decade or so, and it shows that inflation more recently in the last year or so is slowly trending a little bit lower. But the history with inflation and longer term trends is that after the initial movement down, it is possible we could see a spike. So again, that's what Chairman Powell is concerned about, especially with the tariff uncertainty out there. So again, basically taking a wait and see approach. But even with that all said, in 2018, we didn't see a spike in inflation when we had tariffs introduced also. So we still think maybe 2 quarter point cuts are in the cards yet for this year. And that's exactly what the financial markets are pricing in. And that should be a positive catalyst for the stock market and the rest of the financial market here.
So Dan, we're halfway through the year, and to kind of recap for everyone, coming into the year, our big picture thought was we'd probably have a slowing economy. Thought financial markets would probably end up the year positive, but with certainly much more modest returns than we've had in the prior couple of years. Obviously, it's been a very tumultuous first 6 months of the year, with that big sell-off that we had, in the end of the first quarter, beginning of the second quarter. I think fortunately we did a good job. We um, held our ground, didn't make any significant changes, didn't de-risk the portfolios as we thought it was going to be more of a transitory move, and fortunately that's played out and been the case. Um, so good news on that front, and so far I'd say we're feeling pretty good about how the first half's played out. But what do we see in the second half of the year coming up?
Yeah, two themes that we already touched on were the fact that we think, the tariffs will be manageable for U.S. companies.
Mhm.
So we expect corporate earnings to still react positively and surprise to the upside, similar to what we've seen the past many quarters. So we think those are positive catalysts. And we talked about the Federal Reserve. We think
Mhm.
one to two, probably two quarter point cuts
Mhm.
yet this year. So growth is slowing. The labor markets are slowing. So we've talked about this soft landing outlook where growth slows from the past couple of years, but doesn't enter, recessionary territory. We think that's a market that calls for Fed rate cuts. Obviously, the housing market is very, very slow with, higher mortgage rates. But as we sit here today, still a lot more positives than negatives.
Well, I'd just like to wrap this up. Thank everyone for joining us. We truly appreciate all the trust and support everyone has given to us over the years. And please don't hesitate to reach out to us if you have any questions or concerns.